Welcome back to Investing Talk Podcast. Today, we are zeroing in on a company that has, well, truly skyrocketed this year. It's sitting right at the intersection of two massive growth areas, cryptocurrency mining and artificial intelligence infrastructure.
We are indeed talking about Terawulf, and the big question really on everyone's mind is this still a good time to buy? Now we've gathered, all the latest analysis, the recent financials, the market buzz, everything to give you a clear picture, the opportunity, and of course the risks.
That's right. And before we really unpack this company, if you enjoy this kind of analysis, please do hit that subscribe button, like the episode, maybe leave a comment below letting us know what other companies you want us to look into next. We do read those.
Okay, so let's dissect this business model.
Yay.
Because if you only know Terawulf as a Bitcoin miner, you're definitely missing a big piece of the puzzle here. They seem to be aggressively positioning themselves as more of a high-performance data center play. That's absolutely the key differentiator. They aren't just another pure-play miner. Not like many of their competitors anyway. Their whole strategy hinges on what we're calling the hybrid approach. They're really one of the first movers integrating these high-margin AI-focused computing services right alongside their Bitcoin mining.
Okay, so hybrid. What strategic problem does that solve? I mean, what's the advantage over those pure miners?
It really comes down to the dynamic use of their energy capacity, especially at their big Lake Mariner facility. See, energy is the single biggest cost for any crypto miner. Huge cost.
Yep.
So when Bitcoin mining profitability dips, or maybe when energy prices suddenly spike, those pure play miners, well, they face massive margin pressure. Sometimes they even had to shut down operations entirely.
Right, so they either lose money on the power or they just stop earning altogether, stuck between a rock and a hard place.
Exactly. But Terawulf, they've designed their infrastructure specifically for, like, dynamic load shifting. They can actually pivot capacity away from Bitcoin mining towards hosting specialized high-value IT load for AI clients. And that stuff usually comes with significantly higher margins and, crucially, more recurring revenue streams. Management's been very clear about this. They call this dual optimization at Lake Mariner a key pillar for future growth. They've already secured partnerships and leases for that high-value IT load.
That structural resilience, that ability to shift.
Yeah.
It sounds like a pretty significant moat against those typical sector headwinds, doesn't it? So connecting this to the bigger picture, it means their revenue profile could be much less cyclical, less dependent on, say, just the price of Bitcoin.
That's precisely it. Yes. When you, the listener, are comparing Terawulf to maybe a Marathon or a Riot blockchain, you absolutely have to factor in this potential for recurring revenue from AI and data hosting. It stabilizes the whole investment thesis, really. It shifts it away from being just a pure crypto gamble, more towards an infrastructure play backed by this surging demand for AI compute power.
Okay, let's switch gears. Let's talk money, the financials, because we see these phenomenal top-line growth metrics, but there's also this significant current loss. To understand why the market seems okay with the $131 million loss, we have to look at how quickly they're actually building scale, right?
Right. And what's fascinating here is just the sheer velocity of that growth. Full year 2024 revenue surged, really surged, 102.3% year over year, hit $140.05 million. And more recently, Q2 2025 revenue came in at $47.6 million. That's a robust 34% increase just from the prior quarter. That's an exceptional acceleration. It shows their capacity expansion is actually monetizing and quickly.
Okay, exceptional acceleration. Yet they reported a trailing 12 months TTM net loss of $131.72 million. That's still a massive loss. How do we, as informed investors, how do you reconcile that triple-digit revenue surge with a triple-digit net loss?
Well, you reconcile it by understanding where that capital is going, where it's being deployed. This TTM loss, it largely reflects the aggressive capital expenditures needed, building out the data centers, the infrastructure required for that high-performance computing load. It's essentially the cost of creating the massive scale we were just talking about. But, and this is important, we also note that the rate of losses is actually starting to slow down a bit. The net loss narrowed by about 1.37% in 2024 compared to the year before. That suggests operational efficiency is improving. Scale effects are maybe starting to materialize.
So the market isn't really looking at today's bottom line, the GAAP profitability. They're focused more on the trajectory, the future capacity.
Absolutely. I think that's right. And the Q2 earnings report kind of supports this view. The EPS was negative 0.05 cents, which is actually only slightly below the consensus estimate. It shows the market is already pricing in these continued, temporary losses. They see it as an investment for future dominance. The bet is heavily on that trend continuing, driven by that accelerating revenue.
Okay, that makes sense. And it brings us perfectly to the capital structure, because the only reason we can really look past those TTM losses is because of this potential institutional commitment, right? The fuel needed for this growth.
Exactly. That's the headline news right now, sort of overshadowing everything else. Their plan to raise a staggering $3 billion via debt financing. And let's be clear, this isn't rescue capital. This is growth capital, purely aimed at aggressive scaling of their data center and high-performance computing capabilities across all their sites.
$3 billion. That is
Yeah.
huge, especially for a company with a market cap that's, well, significantly lower than that figure currently. So who is backing this, and why would major institutions commit that kind of money to an operation that still includes crypto mining?
See, that's the crucial piece here. This changes the entire risk profile. Morgan Stanley is structuring this massive debt raise. That's significant in itself. But critically, and this is the part that really signals deep institutional conviction, Google is involved as a key backer.
Google, wow, okay. Why would a company like Google, I mean, they have virtually unlimited capital, why back a high-growth data center operator that started in Bitcoin mining? That feels like more than just a standard loan.
It signals, I think, a strong belief in the strategic value of Terawulf's underlying assets, especially their green energy infrastructure. Google needs massive amounts of power and data center space for all its AI initiatives. Everyone does. By backing this financing, Google is effectively, well, maybe securing access to future capacity, or at the very least, it's validating the quality and the potential of Terowolf's high-performance computing strategy. Their involvement really transforms that debt from just a potential burden into more of a stamp of technological approval, a big one.
Okay. So even though standard financial metrics, things like current and quick ratios, might flash some warning signs about liquidity in the short term, the fact they hold a decent $90 million reserve in cash and Bitcoin, plus this imminent $3 billion infusion that basically contains the near-term financial risk, assuming, of course, that the debt financing closes as expected.
Precisely. Yeah, that's the key assumption. If you, the learner, are watching this stock, you probably need to focus less on the day-to-day price right now and more on that closing date for the $3 billion.
Yeah.
That event is the fundamental de-risking moment.
All right, let's move on to the price action itself. Looking at the chart, is the momentum we're seeing confirming this institutional interest in this growth story?
Oh, decisively yes. The technicals look extremely strong right now. The stock's currently trading around $11.60. That's practically grazing its 52-week high of $11.79. And just to put that in perspective, this is up dramatically from its lows this year of $2.06. It shows a really powerful, sustained uptrend all year long.
And what are the key technical levels, the sort of confidence-building levels we should be watching?
Well, the shares are trading comfortably above both major moving averages, which is always a good sign. The 50-day simple moving average, or SMA, that's basically the average price investors paid over the last couple of months, a key short-term trend indicator that sits down at $8.12. And even more critically, the 200-day SMA, which signals the longer-term trend, is way down at $5.26. When the current price is this far above both those levels, it really confirms exceptionally strong upward momentum. Hard to argue with the chart.
And how is Wall Street interpreting this blend of strong technicals and the fundamental story of scaling up? What are the analysts saying?
The analyst consensus is overwhelmingly positive. Really is. We have 10 analysts currently rating the stock a strong buy. That's pretty unanimous. The average 12-month price target is already set at $12.10. Now, that suggests maybe limited immediate upside from today's $11.68 of price, but it certainly validates the current valuation.
But I saw there are some outliers, analysts who see much bigger potential here.
Yes, absolutely. And this is where that AI story really seems to lift the ceiling. Roth Capital, for instance, recently raised its price target quite dramatically, all the way up to $21.50. And they explicitly justify this much loftier goal by citing that accelerating AI-driven demand and the company's specific data center expansion capabilities. They're clearly modeling the value based not just on Bitcoin mining, but really on those premium computing services. That's the kicker for them.
Okay, so for you, the learner, listening right now and wanting to know what happens next, what are the crucial short-term catalysts? What should we be watching for in the final months of the year? Seems like a busy period.
It really is. The next 3 months are absolutely packed with activity that could drive significant share price movement. Volatility, for sure. The immediate focus, I'd say, is on the operational and financial checkpoints.
Okay, first up would be the next major earnings release.
Right. Q3 2025 earnings. That's expected around November 11th. Analysts are generally anticipating they'll deliver another strong revenue beat. And critically, show further progress on margins. They need to prove that scaling is translating to the bottom line, or at least moving clearly in that direction.
And second, that huge elephant in the room, the capital commitment.
The $3 billion debt financing close. Yes.
Yeah.
This is absolutely critical. It's expected to be finalized before the end of the year, and that's really the trigger that unlocks their entire aggressive expansion plan. If it closes smoothly, without any hitches, the market will likely, breathe a huge sigh of relief and probably reprice the stock based on that confirmed growth runway.
Okay. Third catalyst.
Institutional holdings disclosure. That's coming up on October 31st. Now, we already know Morgan Stanley and Google are involved in the debt, but updates here on who else is buying or selling can attract or amplify buying pressure. Other large funds often look for that kind of confirmation.
Right. Follow the leader. And finally, there's some significant market chatter, right? Something that could affect passive investment flows.
Indeed. There's quite a bit of speculation going around. Because of this hybrid model and the increased focus on data centers, there's talk of the company might get added to thematic ETFs, maybe AI ETFs, maybe green energy ETFs. That often happens during the November rebalancing window for many funds. And, inclusion in a major ETF attracts substantial passive inflows. Money just comes in automatically, which drives up buying pressure regardless of the day's news.
Interesting. And beyond those sort of scheduled events, we are also seeing some speculative buzz, aren't we? Particularly around maybe further strategic alliances beyond just Google.
Yeah, you see that floating around on market forums and social media. Mentions of unconfirmed possibilities, maybe expanded enterprise contracts, even partnerships with other major cloud providers, perhaps. Now, these are currently just rumors, market chatter, let's be clear. But the potential for these deals to materialize is certainly adding to some of the current market optimism and the trading volume we're seeing. So to sort of summarize our analysis here, the overall investment thesis looks highly bullish and really strongly positive. The stock offers that rapid revenue acceleration we talked about, confirmed technical momentum on the charts, and very positive sentiment from major institutions like Google and top-tier analysts. It really seems attractive for both short-term trading, given how packed the catalyst schedule is over the next quarter, and potentially for a long-term investment if you believe they can capitalize on that competitive edge in the hybrid AI data space.
So what does this all boil down to for you listening? I think the crucial element moving forward is really understanding that you're investing in the competitive gap that Terowulf seems to have established, bridging these two huge industries. It's almost like an infrastructure stock disguised as a crypto miner, in a way.
That's a good way to put it. And this raises, I think, an important final question for you to consider, a bit of food for thought. If the AI industry really does accelerate its demand for high-powered green compute capacity even faster than expected, and assuming that $3 billion debt financing closes successfully, does that potentially make Terawulf a prime strategic takeover target down the road? Maybe for a much larger data infrastructure player, or even a renewable energy giant looking for immediately available massive scale. Definitely something to mull over as we head towards that November earnings report.